Welcome back to Boni's Life, where we cut through the noise, ignore the mainstream media propaganda, and decode the crypto markets with hard facts, raw data, and just enough caffeine to keep us all sane. If you are new here, hit that subscribe button right now, because this week, the market is serving up a volatile cocktail of extreme fear, regulatory showdowns, and technical breakouts that you absolutely cannot afford to miss. We are looking at the week of April 14th to the 18th, 2026, and let me tell you, the charts are screaming. This is not a drill. We are at a massive inflection point, and the decisions you make in the next few days could define your portfolio for the rest of the year. Let us start by looking in the rearview mirror at the technical damage and the subsequent recovery from the past week. Bitcoin has been on an absolute wild ride, testing the nerves of even the most seasoned veterans. We started the week hovering around the $68,860 mark, and after a brief terrifying dip that shook out the weak hands, we saw a massive recovery pushing us back up to the $73,000 level. That is a solid 6% weekly gain, driven largely by the geopolitical ceasefire rally that violently squeezed out the over-leveraged shorts. But do not let that massive green daily candle fool you into a false sense of complacency. The Relative Strength Index, or RSI, for Bitcoin on the daily time frame is sitting right around 51 to 56. That is dead neutral. It means the market is holding its breath, waiting for a definitive macroeconomic catalyst to pick a direction. Right now, Bitcoin is trapped in a massive high-stakes range. We have critical support holding incredibly strong between $68,000 and $69,000. Every time we dip into that zone, buyers step in and aggressively defend the line. On the upside, the absolute critical resistance to watch is $74,800. If we can break and, more importantly, close a daily candle above that $74,800 level with significant volume, technical analysis points to a rapid, violent expansion toward the $76,000 to $80,000 zone. The order books are thin above $75,000, meaning price discovery could happen in the blink of an eye. But if that $68,000 support fails, we could easily slide back down to test the $62,000 to $66,000 range, wiping out weeks of progress. Ethereum is showing a remarkably similar pattern, currently holding the $2,200 support level on the 0.236 Fibonacci retracement. It is fighting to maintain its structure while Bitcoin dominance sits high at nearly 59%. Meanwhile, Solana is consolidating tightly with an RSI of 49, eyeing a massive resistance zone between $90 and $95. The technicals across the board are coiled like a spring, compressing tighter and tighter, and the fundamental events we are about to discuss are the exact triggers that will release that energy. Speaking of fundamentals, let us talk about the macroeconomic wrecking ball that just dropped on the traditional financial markets, the United States Consumer Price Index. The March CPI report came in hot at 3.3% year over year, up significantly from the 2.4% reading we saw in February. Now, mainstream financial headlines will immediately tell you that inflation is back with a vengeance and that you should panic sell your risk assets. But here at Boni's Life, we dig deeper into the actual data. If we look closely, this CPI spike was heavily, almost exclusively, driven by surging energy costs linked directly to the recent Middle East conflict. Interestingly, core CPI, which strips out volatile food and energy prices, actually missed estimates, coming in at 2.6% versus the expected 2.7%. That crucial nuance is exactly why Bitcoin surged past $73,000 right after the data release. While traditional equities stumbled, the smart money realized that the underlying inflation trend is actually cooling despite the headline shock. However, this mixed inflation data severely complicates things for the Federal Reserve. We have the highly anticipated FOMC minutes dropping this week, covering their March decision to hold the federal funds rate steady at 3.50% to 3.75%. The market is currently pricing in a 65% chance of a rate cut in June. But here is the massive catch that nobody is talking about. 7 out of 12 Fed committee members are now projecting 0 rate cuts for the entirety of 2026. Let that sink in. If the FOMC minutes reveal deep internal division, or if they lean heavily hawkish because of this recent headline CPI print, expect immediate violent volatility across all markets. As the brilliant analysts at Kraken Intelligence pointed out this week, The combination of the CPI data and the FOMC minutes creates a defined reaction window where traders will rapidly reassess the probability of any monetary easing. Now, let us pivot and look at the global events and the crypto-specific calendar for this coming week, because it is absolutely packed with market-moving catalysts. First up, we have the Clarity Act heading to the Senate Banking Committee for markup between April 13th and 18th. This is massive. This is the regulatory showdown we have been waiting for. The bill aims to provide a clear, comprehensive regulatory framework for digital assets, stablecoins, and decentralized finance in the United States. Senator Cynthia Lames has confirmed the timeline, and Polymarket currently gives it a 72% chance of becoming law this year. But it is not without massive political friction. U.S. Treasury Secretary Scott Bessent recently went on record calling crypto leaders who are resisting certain restrictive stablecoin provisions nihilists. The rhetoric is heating up. If this bill clears the committee this week, it is a massive, undeniable bullish catalyst for the entire industry, finally providing the regulatory certainty that trillion-dollar institutions have been begging for before they fully deploy their capital. Across the pond, the narrative is shifting to Europe as Paris Blockchain Week kicks off on April 15th and 16th at the Carrousel du Louvre. We are talking about 10,000 top-tier decision-makers, including heavy-hitting executives from OKX, eToro, and crucial figures from the European Commission. Historically, major institutional announcements, massive protocol partnerships, and significant ETF updates are perfectly timed to coincide with this specific event. Keep a very close eye on the newsfeed coming out of Paris over these 2 days, as it often dictates short-term altcoin momentum and sets the narrative for the next quarter. We also have some highly significant token unlocks happening this week, most notably for hyperliquid Layer 0 and Toncoin. Now, conventional wisdom says that token unlocks usually introduce massive sell pressure as early investors dump their bags. But in a bull market, they can also be incredible buy the dip opportunities if the underlying fundamentals of the project are strong. Take Hyperliquid, for example. Arthur Hayes, the legendary co-founder of BitMEX and one of the sharpest macroeconomic minds in the space, recently stated he is incredibly bullish on the project. He set a massive $150 price target for the HYPE token by August 2026. When Arthur Hayes speaks, the market listens. Hayes is also heavily backing privacy coins right now, suggesting that as government surveillance over financial transactions inevitably increases, the premium on absolute financial privacy will skyrocket. So what are the traditional experts and institutional analysts saying about the broader market right now? It is a completely mixed bag, which is exactly what you expect to see at a major market inflection point. Analysts from Barclays and Oppenheimer have issued stark warnings about a major first quarter profit squeeze, suggesting the crypto honeymoon might be over for now. They are looking at the fact that Bitcoin is still down roughly 20% year to date from its early 2026 highs and assuming the trend is broken. But on the flip side, if we follow the actual money trail, we are seeing a massive, undeniable return of institutional capital. Just a few days ago, BlackRock's iShares Bitcoin Trust saw a staggering $269 million in net inflows in a single day, marking a 5-week high. Fidelity and other major issuers are also seeing positive flows return. When BlackRock is aggressively buying the dip while retail panics, you have to pay attention. They do not deploy hundreds of millions of dollars based on emotion. They deploy based on long-term data models. Furthermore, the on-chain data from CoinGlass shows an incredibly bullish setup. The Bitcoin exchange balance has dropped by nearly 6,000 BTC in the last 24 hours alone, bringing the total available supply on exchanges down to just 2.45 million coins. Coins are rapidly moving off exchanges and into deep cold storage. This creates a classic supply shock scenario. The available supply is shrinking exactly as institutional demand is ramping back up. At the same time, the fear and greed index is sitting at 17, which indicates extreme fear. Historically, when the market is this terrified, when retail is capitulating, and when institutions are quietly accumulating in the background, it is the absolute perfect recipe for a massive contrarian long position. So, how do we actually trade this? What is the actionable strategy for the next week? First, you must understand that the market is highly leveraged right now. We have seen over $316 million in liquidations in the past 24 hours alone, mostly from overeager traders getting chopped up in the volatility. The long to short ratio is split almost exactly 50-50. This means market makers are going to aggressively hunt for liquidity in both directions before making a definitive move. If you are trading Bitcoin, your absolute invalidation level for any swing long position is a daily candle close below $68,000. As long as we hold above that critical line in the sand, the broader bias remains cautiously bullish. The optimal strategy right now is disciplined range trading. You want to buy the support retests near $69,000 and aggressively take profits near the $74,000 resistance. Do not try to front-run the breakout. That is how you get liquidated. Wait for a confirmed daily candle close above $74,800 with strong, undeniable volume before entering a breakout trade targeting the $80,000 level. For Ethereum, watch the $2,100 to $2,200 level closely. If Bitcoin dominance, which is currently sitting very high at around 59%, finally starts to break down and reverse, we could see a massive wave of capital rotate out of Bitcoin and directly into Ethereum and high beta altcoins like Solana. For Solana specifically, a confirmed break above $85 opens the door for a very quick, violent trade up to the $95 resistance zone. Remember, with the FOMC minutes dropping and the Clarity Act markup happening this week, you must use strict stop losses. The negative funding rates on Binance suggest that retail traders are leaning slightly bearish right now, which often provides the exact fuel needed for a massive short squeeze. Do not get caught over-leveraged when the headlines hit the terminal. Trade the levels, manage your risk meticulously, and let the hard data guide your decisions, not your emotions. That is the comprehensive blueprint for the week ahead. We have covered the technicals, the macro data, the regulatory showdowns, and the exact levels you need to watch. If you found this deep dive analysis valuable, hit the like button, subscribe to Boni's Life, and let me know down in the comments if you are buying this dip or waiting for lower prices. Stay sharp, trade smart, and I will see you in the next episode. Now let us take a step back and look at the broader long-term implications of what is happening right now in the crypto market. We are not just trading lines on a chart, we are witnessing a fundamental shift in global finance. The fact that the United States government is actively debating the Clarity Act, a bill specifically designed to regulate and integrate digital assets into the traditional financial system, is a monumental milestone. Just a few years ago, the narrative was that Bitcoin was a fad, a bubble, or worse, a tool for illicit activities. Today, we have sitting US senators, treasury officials, and the largest asset managers in the world like BlackRock and Fidelity actively participating in the ecosystem. This is the definition of institutional adoption, and it is happening right before our eyes. But with institutional adoption comes institutional manipulation. You have to understand that the players entering the market now are not retail traders looking for a quick 10 times return on a meme coin. These are sophisticated algorithmic trading firms with billions of dollars at their disposal. They thrive on volatility and they actively hunt for liquidity. When you see a sudden violent drop in the price of Bitcoin that triggers hundreds of millions of dollars in liquidations, that is not an accident. That is a calculated move by large players to shake out weak hands, clear their order books, and accumulate assets at a discount. This is why risk management is more critical now than ever before. You cannot afford to trade with emotion. You must trade with a plan, a strategy, and a deep understanding of market mechanics. Let us talk about the concept of the supply shock that I mentioned earlier. Bitcoin has a hard-capped supply of 21 million coins. That is it. There will never be any more. Currently, over 19 million of those coins have already been mined. But here is the kicker. A significant portion of those mined coins are lost forever, locked in wallets with forgotten passwords, or held by long-term believers who refuse to sell at any price. The actual liquid supply of Bitcoin available for trading on exchanges is incredibly small, and as we saw from the CoinGlass data, it is shrinking rapidly. When you combine a shrinking available supply with massive sustained institutional demand driven by the spot ETFs, you create a perfect storm for exponential price appreciation. This is basic economics. High demand plus low supply equals higher prices. This supply dynamic is also why the recent Bitcoin halving event is so important. The halving, which occurs roughly every 4 years, cuts the block reward given to miners in half. This means the rate at which new Bitcoins enter circulation is drastically reduced. Historically, every single Bitcoin halving has been followed by a massive multi-month bull run, We are currently in the post-halving window, and the market is still digesting the impact of this reduced issuance. The miners are feeling the squeeze, especially with the recent US tariffs on steel, aluminum, and copper driving up the cost of mining hardware. But for investors, the halving is a massive long-term bullish catalyst that cannot be ignored. Now let us shift our focus to the altcoin market, because that is where the real generational wealth is made. While Bitcoin is the undisputed king of crypto, the altcoin sector offers unparalleled opportunities for outsized returns. But it also comes with significantly higher risk. When Bitcoin sneezes, the altcoin market catches a cold. That is why we always monitor Bitcoin dominance. Currently, Bitcoin dominance is sitting near 59%, which is relatively high. This means that the majority of capital flowing into the crypto market is going directly into Bitcoin. But eventually, that capital will start to rotate. Investors will take their profits from Bitcoin and look for higher yielding opportunities in the altcoin market. This is what we call altcoin season. When altcoin season hits, the gains can be truly staggering. We are talking about project doubling, tripling, or even 10xing in a matter of weeks. But you have to be positioned correctly before the rotation happens. That is why we are keeping a close eye on Ethereum and Solana. Ethereum is the foundation of the decentralized finance and NFT ecosystems. It has the most developers, the most decentralized applications, and the most total value locked. Despite its recent struggles against Bitcoin, Ethereum remains a fundamentally strong asset with massive long-term potential. The upcoming Pectra upgrade, which aims to significantly reduce gas fees and improve scalability, could be the catalyst that finally ignites a massive Ethereum rally. Solana, on the other hand, is the high-performance challenger. It offers lightning-fast transaction speeds and incredibly low fees, making it the preferred platform for high-frequency trading, meme coins, and decentralized physical infrastructure networks, or DePIN. Solana has been one of the strongest performers in the current market cycle, and its ecosystem is growing at an explosive rate. If Solana can break through that critical $95 resistance zone, we could see a rapid acceleration toward its all-time highs. But remember, Solana is also highly volatile, and it is prone to sudden, sharp corrections. Always use stop losses and never invest more than you can afford to lose. Beyond Ethereum and Solana, there are several other sectors within the altcoin market that are showing incredible promise. Artificial intelligence, or AI, is arguably the hottest narrative in the tech world right now, and that enthusiasm is spilling over into crypto. Projects that combine AI with blockchain technology such as decentralized computing networks and AI-driven trading algorithms are attracting massive attention and capital. Similarly, the tokenization of real-world assets, or RWAs, is a massive multi-trillion-dollar opportunity. By bringing traditional assets like real estate, stocks, and bonds onto the blockchain, RWA projects are bridging the gap between traditional finance and decentralized finance. This is a sector that is perfectly positioned for massive institutional adoption in the coming years. And let us not forget about the privacy sector. As I mentioned earlier, Arthur Hayes is incredibly bullish on privacy coins right now, and for good reason. As central bank digital currencies, or CBDCs, become a reality, and as governments around the world increase their surveillance over financial transactions, the demand for absolute financial privacy will skyrocket. Privacy coins offer a level of anonymity and fungibility that is simply not possible with transparent blockchains like Bitcoin and Ethereum. While privacy coins often face intense regulatory scrutiny, their fundamental value proposition is undeniable. If you believe that financial privacy is a fundamental human right, then privacy coins deserve a place in your portfolio. So as we navigate this incredibly complex and volatile market, what is the ultimate takeaway? The key to success in crypto is not timing the market perfectly, it is time in the market. It is about surviving the inevitable drawdowns, managing your risk meticulously, and staying focused on the long-term fundamentals. The noise, the FUD, the mainstream media headlines, it is all designed to shake you out of your positions and separate you from your wealth. Do not fall for it. Do your own research, trust the data, and stick to your strategy. This week is going to be a wild ride. We have the CPI data, the FOMC minutes, the Clarity Act markup, Paris Blockchain Week, and massive token unlocks all converging at the exact same time. The volatility is going to be intense, and the opportunities will be massive. But remember, volatility is a double-edged sword. It can create incredible wealth, but it can also destroy it in an instant. Trade smart. stay disciplined, and never let emotion dictate your decisions. Thank you for tuning in to Boni's Life. If you appreciate this level of deep, unfiltered, data-driven analysis, make sure you hit that like button, subscribe to the channel, and turn on notifications so you never miss an episode. And I want to hear from you in the comments below. What is your top altcoin pick for the upcoming altcoin season? Let me know, and I might feature it in a future episode. Until next time, stay sharp, stay focused, and I will see you on the charts.